Chaos is coming. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, a political crisis of historic proportions is imminent, and I want you to understand that the decisions of one government agency are now setting up to change the tide of who could be the next president and the fate of their presidency. The fallout, as you're about to see, is going to be huge. Now, let's head over to Bloomberg, where he picked today's story up with a headline, as the Fed risks a political backlash by spurring the economy close to the election. And what I want to understand is the move by the Federal Reserve here is extremely rare. They almost never change the funds rate going into an election. In this case, they drop interest rates by 50 basis points, and yet there's another meeting the week right before the election. And what this is setting up is for a massive amount of political backlash as changes to the U.S. economy could change the outcome of who the next president is and what their term in office looks like as the economy now is on shaky ground. For most central bank officials, there was clear economic case for Wednesday's decision to lower borrowing costs by 0.5 percentage point, a bigger than usual move now that inflation has been tamed and the job market is losing steam. And this is all on the back, as we've shown you on the show many times, based on what the bond market is telling the Fed. The interest rates on 2-year, 6-month, and 3-month treasuries are all declining, telling the Fed that the financial conditions for the U.S. economy are not getting easier, they're getting tighter, telling the Fed they're behind the curve. The policymakers had absolutely no choice to react, but it's how the world perceives this and what happens between the now and the election with the economy that could change everything. And awkwardly for policymakers, the first rate cut in 4 years arrives near the climax of a presidential contest that may hinge on how voters feel about the economy. And generally, this is true. When things are good, people vote with their hearts. But when the economy is slowing down, they vote with their wallets. This is one case we're seeing very clear signs the economy isn't getting better, that it's getting worse and likely to get worse by the time that voters go to the polls. And here we can see it could give markets and everyday Americans a morale boost if the economy turns around, which could help a Democratic campaign that hopes to cash in on an upbeat economic vibe. And you start to get a picture of the economic fallout here and the political backlash that could happen by the move the Fed's making here. We've already seen the reaction by the equity markets as stocks zoomed higher. The question is, will the economy continue to run, or will it actually faceplant by the time the election gets here? And we can look going back with a substantial amount of history, and we can see that Fed rate cuts are generally not good for the labor market, which is now at a turning point. Here we can see the federal funds rate in blue against the unemployment rate in red. And the popular belief that is spun by the Federal Reserve is that if we lower interest rates, it eases financial conditions, it causes consumers and businesses to go out and spend, and that drives the economy, of course, puts more Americans to work. But the data suggests completely the opposite. And we're going back here to the 1950s. You can see the Fed cuts rates, and the unemployment rate skyrockets. Happens again in the early 60s. Once again, going into the 1970s, the mid 70s, the 80s, the 90s. And we continue with this. The dot-com bubble, global financial crisis, and now we're in the same setup we've seen in the past, where we notice the unemployment rate starting to rise. The Fed starts to cut rates, but it doesn't change the trajectory of the economy. In fact, in the late 1980s, the Fed hoped to get ahead of that trend, and it didn't work. This time, once again, we know that there's something structurally wrong with the labor market, something that's not showing up very clearly in the data, and the Fed is absolutely worried about this because, again, if the economy heads into a recession by the time we get to the election, it's generally not good for the incumbent party. If the economy is booming, it could be great news for them and put them back in the office for another 4 years. But the risk is that cutting rates will improve the economy, and it will look to a lot of people, a lot of bystanders, and a lot of lay people like the Fed is trying to improve the economy before the election to help one of the candidates. And yes, this is how the perception will be. And we're going to see a lot of political commentary about the Fed making this move so close to election. But one of the problems is most people actually don't even know what a change in the federal funds rate means to them. In fact, I've asked many people over the last several days since the Fed cut rates, what what it means to their household budgets. Not one person could give me any sort of answer on how it will directly impact them, but that won't change the view of people who are hoping that their candidate wins the next election. And we can talk about one thing that it could have an impact on, but the delays of it, well, are so far out that it's not going to have any material impact between now and the election. As we look at the federal funds rate against commercial bank interest rate on credit card accounts. Now, you notice there's not a line. The data shows up in dots here, but I wanted to point out that you see here going to the dot-com bubble, the Fed is cutting rates, and with a substantial lag, you start to see credit card interest rates go down. You see that happen again right around the global financial crisis and just in the early phases as we head into recession, but notably a small decline in the cost of money for most households isn't going to free up a substantial part of their budget where they're going to feel better about the economy and go out and spend. And so one of the issues here we face is, does the Fed have any impact on the real economy, or is it all about perception? And sometimes perception is far better than reality. Vice President Kamala Harris, a Democratic candidate, described the rate cut as, quote, welcome news for Americans, and actually hoping that this keeps the economy booming so she can take the office, while President Joe Biden called it an important moment. Now, we talked about this on the show the other day because he's quoted by saying inflation and interest rates are falling while the economy remains strong. And again, this is something the political elites don't realize, that lower rates aren't actually a good thing. It perceives to be a good thing, but it means financial conditions are tightening. We see that in bond yields. They're headed lower, telling us that the trajectory for the U.S. economy isn't a continuation of the good times. It's telling us we're headed squarely into a recession. Trump took the opposite tack. Quote, I guess it shows the economy is very bad to cut by that much, assuming they're not playing politics. And he's got it right. It does mean the economy is bad. Does it mean the Fed's playing politics here? I'd love to know what your opinion is. Weigh in the comments. What do you think? Is the Fed being apolitical, just doing their job? Or do you think there's some motivation by the Fed chief and the board to keep somebody, or get somebody that is, into office? But something you should be counting on is making money in this market. You might have heard the recent story that 3 Mile Island is going to reopen, selling all the energy to Microsoft. Well, check this out. On September 13th, our CTA Time Pro flagged a buy in uranium. Here's the ETF URA. Here's the notes, the actual notes that I sent out to the subscribers. And here you can see, as of yesterday, as of Friday, uranium closed up 4.9%. Could you imagine making money that quick in the markets? Well, the answer is you can, and it's super easy. All you have to do is be able to put in a trade, because over 2 hours before the market opens, we publish the reports and my opinions. You pick the one you want. All you have to do is place a buy it open trade, or place a trade later that day and put your stop loss on. You go about your life. Don't worry about it. We'll have you update your stop losses once a week, which you can do sooner, and you profit. It is that simple. You don't have to sit in front of the computer, but you get the reports, you get the signals, you get my opinion, you get the backtest data on CTA, and yes, we're working on it for both our reports. Stop loss levels, full tracking of all the trades and returns, weekly update on the stop loss levels. Here's the two best parts. 100% duplicatable, 30-day free trial. Look, you can make money trading without all the time investments. Link in the description below. Jump on that 30-day free trial while supplies last, because the Fed's own view of the economy skews optimistic. In fact, that's what we normally hear from policymakers. They're never going to come out and say, hey, you know, the economy is looking bad, or we think it's going to get substantially worse, because if that happened, then the public perception would be, hey, they know something we don't know, and spending would all shift in the opposite direction of what the policymakers want. People will curtail their spending activities, they start paying down on their debt, building up their savings, and then put the economy into a recession. So you'll never hear policymakers say that, because they're hopeful they can pull off a soft landing, a rare feat, in fact, so rare it's never actually happened, in which rate hikes help guide inflation back down to the central bank's goal without triggering a recession. But officials are ultra wary of the risks on both sides. If you cut too aggressively, and price pressures could rekindle, which the data really isn't clear actually happens, too timidly, and unemployment could spike. That fine calculation explains why this week's rate decisions was in the balance until the last moment. but the market's unsure of what to expect. And I don't buy that either, because the markets knew exactly what to expect. I said publicly there would be a 50 basis point hike. It's not because I had some fancy calculator to look at all the data the Fed claims they do. I just looked at the bond market, and it was very clear. Where the bond market goes, well, the Fed follows, and they know financial conditions are tightening. They don't know why, but they know things are going to get worse. Let's talk about the claim that, of course, you could see a rise in inflation. In fact, we only can go back about 3 times where we see the Fed cutting here in the mid-90s, and what happens? Inflation trends up a little bit here, looking at the CPI on a year-over-year rate of change. And again, you see going into the global financial crisis, the Fed starts cutting, but do those rate cuts really lead to higher inflation, or was it oil? Well, the answer was it was always about the energy market. Oil prices skyrocketed there. That drove inflation. It was nothing to do with the Fed, but we could say perhaps there is some correlation there if we want to believe that. And then let's talk about what happened going into the pandemic. The Fed cuts rate. Inflation does come back up again, but nowhere near the 2 prior highs. Again, suggesting, is there any actual data that tells us that cutting the funds rate could lead to inflation? Well, the answer is no. In fact, right now we see inflation looking like it's headed right toward the Fed's 2% target and going to blast through that right to the downside. But the real question is, what drove inflation during those periods? We'll talk about total income or total compensation, where we look at average hourly earnings multiplied by average weekly hours of production of non-supervisory employees. This shown in blue on a year-over-year rate of change. And when we see it against the consumer price index, it starts to make sense that the Fed really had nothing to do with this, because we know the total compensation growth was rising here in the mid-90s. Well, that means demand rising. Of course, that sends inflation higher. We go into the global financial crisis. What do we see? Total compensation growth was relatively high. And yes, there was demand for energy, but there was also some impact inside that sector alone that drove prices higher. There we can see validation. It was all about the consumer. And once again, you see going into the financial, or going into the pandemic, that is, what happened? Well, wage growth was relatively strong historically. That drove prices higher. This time, what do you see? We see total compensation growth decelerating, telling us that inflation is coming down, perhaps not as fast as everyone wants. But getting these calls right is the key to maintaining broad public support. This from Randall Quarles, a Trump appointee to the Fed who served as vice chair of supervision until 2021. Public opinion, he says, it moves around, but it will ultimately anchor itself in the longer-term success of their decisions. This is why they are so focused in referring to the Fed on ensuring that those decisions are technocratically grounded as opposed to driven by any political considerations. But here's the problem. The Fed doesn't give us any of the data. They just say based on the data, they're doing something. They don't give us the formulas. They don't let anyone fact check anything they do. They have full autonomous power to make changes to the funds rate and the balance sheet. And yes, they give us many excuses. Well, the labor market looks like it could trend higher. Well, inflation's coming down. So we're going to make adjustments to the rate here. But yes, there is one part of this that does matter. It is ultimately anchored on the long-term success, because if the Fed sends us into the recession, which we know historically they're going to do, it could look like they're trying to keep the Democrats in the White House. We'll see what the public opinion is as we go forward. But as I started the show out, there was one very clear path to lower funds rate, and that is the bond market. Here we look at 2-year Treasury yields. We see they're breaking down to the downside. This doesn't tell you the financial conditions are easing. It tells you they're getting tighter. And why do yields fall in a debt-based economy? It's for one very specific reason: to spur credit growth, to create new money. Because when central bankers invert yield curves and money curves, they constrict the creation of credit. So how do you create credit in a system that's starved of credit? Well, naturally, the system itself, not the banks, not investors, not foreign investors, yields just start to fall because the system is getting starved of money. And if money isn't created soon enough, well, we're going to end in a recession. That'd be the best case. What it points to is a potential all-out financial crisis. And the Fed knows this, which is why when they saw yields falling, they just made up all the reasons why they need to validate it as they now start to chase 2-year yields lower. And Powell has repeatedly said the Fed only considers what's best for the economy when he sets policy. Well, actually, he has no clue what the right thing is because he never tells us, reiterating the message at the press conference on Wednesday when he was asked about the impending election. Of course, the Fed wants to remain apolitical. That's at least their goal, at least publicly, is to say that we do not influence politics. But we know, of course, Fed chiefs are appointed by presidents. They work for Congress. So we know there is some political motivation here, no matter what they say. But this time, due to the fact that they actually cut rates this close to election, which again, they normally don't ever do, the political fallout from this could be massive. Senator Kramer of North Dakota, for example, is among the Republicans who were critical of the central bank this week. Fed officials claim to be politically independent, he said, but they could have waited to move rates until after the election to confirm it, and that is a valid point. And I believe this is going to come up more and more in the political news of, is the Fed trying to influence the election here? Could they have waited until elections were over? They absolutely could have, but they didn't. And nevertheless, we see an economist who worked for the White House during the Biden administration says, quote, the Fed is more politically vulnerable than it has been in decades. I agree with this statement. If they can land the plane successfully, which of course we know they have a 0% track record of success doing, the lateness of their initial response will be mostly a footnote. But if they don't, it's going to be a cautionary tale in many ways. So there is really a lot at stake here. And yes, it's all about the Fed's credibility. One of the problems is they claim that monetary policy works with long variable lags. How long? Well, they don't actually know. How variable? They're not sure. In this case, if that was the data setting the economy, showing the economy that is heading into a recession, the Fed should have cut much sooner. So yes, the Fed's credibility is highly at stake here. Will this lead to changes in the Federal Reserve office or system? Not sure about that. But there's one person who agrees with me. He says no chance this is really going to work. As Jamie Dimon says, he's skeptical of the soft landing after a rate cut. Well, for good reason, because he actually knows that rate cuts lead to recessions. And I'm a little more skeptical than other people. I give it lower odds, he said. I hope it's true, but I'm also more skeptical that inflation is going to go away so easily, not because it hasn't come down. It has. And it can come down more. I totally agree. It's going to come down far more than he thinks, but it is going to come down further because if more and more people hit the unemployment line, well, demand destruction occurs. We're seeing this at the factory level all over the world. There just isn't enough demand to keep people busy. It's going to send more people around the world to the unemployment line. Their demand's going to go away. Inflation is going to tumble. The rate cut will have almost no effect on the presidential election, he says. And this, when asked if it would have an impact, I kind of agree with that. I think it's going to be a lot of political commentary because we know there's nothing a 50 basis point cut's going to do to the economy and a little over a month before the election. But nevertheless, if there is any change in the economy, people are going to directly blame the Fed. You watch this happen. It's going to. I wouldn't count my eggs, Jamie Dimon said, who's the CEO of JP Morgan Chase. We may have gone from a lower rate, lower inflation, to a slightly higher rate, higher inflation. But down the road, whatever it is, we'll deal with it. Economists, you're used to dealing with that. It's not a disaster. Well, not yet, but it's going to be. You'll see, because as we've shown you in the data, every time the Fed cuts rates, the unemployment rate doesn't go down. It goes up. Inflation goes down. And everything in the economy statistically tells us, with historic accuracy here, the Fed's going to send us right into a recession. But Fed's Wallace says slowing down inflation led him to support a large rate cut because he didn't want to admit that he knows that they're behind the curve and that the labor market's about to come unwound. The Fed governor said he's now estimating the Fed's favorite gauge of inflation, the Personal Consumption Expenditures Price Index, has risen over the last 3 months at an annualized rate of less than 1.8%, suggesting that eventually the year-over-year rate of change will catch up with that and break through the Fed's 2% target. Wallace said he'd likely back quarter-point cuts at each of the next two policy meetings, one before the election and then in December, if the economy evolves as he expects. Of course, we know that based on their dot plots and the projections, the economy never goes as they expect. Not one time. They get it wrong every single time. And if labor market data worsens, Or if the inflation data continues to come in softer than everybody was expecting, then you can see it going at a faster pace. Of course, if indeed the labor market falls apart, they're going to aggressively cut. What the Fed really needs right now, if you want to look at the bigger picture here, they need something that is to go wrong in the global economy so they can say, hey, it wasn't our fault. We didn't see this coming, but look at how we reacted. Right now, there's nothing that gives them any out. So right now, all fingers pointed at the Fed. And the Fed's Bowman says a big rate cut could be seen as claiming a victory too soon. Keep in mind, she was the one who actually said that he wanted to go a quarter basis point. This is rare. Hasn't happened since 2005, where we see a member go against everybody as with the first rate cut. But she's worried that demand will continue to drive price gains, as she's quoted saying, "I'm taking signal from continued solid growth in the spending data." Not sure what she's looking at, particularly the consumer spending, reflecting a healthy labor market. Inflation remains above our 2% goal as core personal consumption expenditures prices are still rising faster than 2.5% from 12 months earlier, but not much longer, Ms. Bowman, because again, I don't know what data you're looking at, but retailers are not in that great of shape. Here we can see advanced retail sales in blue. This is looking at inflation-adjusted data by subtracting off the consumer price index. Here we can see retailers are not even keeping up with inflation in their sales data. And look what happens when the unemployment rises. Well, we see very clearly throughout history that retail sales data continues to slow and can turn negative. Right now, it's already negative, suggesting if it gets any worse, the small businesses not are going to just lay people off. They're going to outright fail, and the timing of this could not be worse. So as we started out the show, you can see there's going to be a lot of political backlash. What the Fed really needs is an escape path here. Will they get it? We don't know, but the election will be here very soon, and I believe that there's going to be a lot of commentary, a lot of fingers pointed right at the Fed as we head in to the election. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.